Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy update. This week I'm going to look at the extraordinary divergence between conditions in the real economy, 36.1 million infections now recorded worldwide, new records in Spain, France, the Czech Republic, and the extraordinary economic damage and scarring that that's caused, and the comparative calm of financial markets, and the extraordinary fact that most assets have actually appreciated from the beginning of the year 2020 for a sterling investor, at a point before which the virus hadn't even been experienced. Credit, government bonds, global equities, residential real estate in many markets are all actually higher than they were at the beginning of the year. How is this possible? So let's look at some slides. Historically, equity markets have struggled after deep recessions. The COVID-19 stock market has charged a very different course. What I've plotted here is the performance of the S&P 500 in 6 historic recessions. In bright red, I've shown the position today, the sharp downturn after the virus struck, and then the sharp rally, the shortest ever on our records, bear market in history. By contrast, as you've seen in most other cases, with the possible exception of 1990 at the top there, equity markets have continued to decline into recession. The worst, of course, in light blue there, being 1929. Why is today so different? Reason one, low inflation has allowed bond yields to fall even lower, plus, of course, central bank support. That means that a 30-year bond today yields just 1.5% in the US. Mr. Johnson, the UK, can borrow for 30 years at 0.88%. And you actually have to pay Mrs. Merkel if you want to lend her money for 30 years in German bonds at -8 basis points. With such a low hurdle, of course, other prices have appreciated. The lower bond yields, the lower interest rates push up the valuations. And you can see on the right here, the S&P 500 historic PE multiple, which is not as high as it was in the dark days of 2008-9 in the tech bubble, but has still appreciated sharply. And that's rippled across other asset prices, credit, real estate, etc., as I've indicated. Reason two is again China. Just as they bailed us out back in the financial crisis, this time in a different way, they're doing something equally extraordinary. What I've plotted here is the contribution to global GDP growth from the major regions around the world. You can see that big dip in 2020, the sharpest drawdown since World War II in global growth. But you can see an extraordinary thing. That light blue slice, China, is actually positive. We expect, because of their virus control, actually record 1.5 to 2% gain in GDP for 2020 and bounce back very strongly in 2021 along with the rest of East Asia. So they again are injecting a much needed component of demand into the world, avoiding, I hope, deflation and contributing, of course, to the avoidance of a sharp sell-off in commodity and energy markets. The third reason that markets have been well supported is the extraordinary behavior of growth stocks. Yes, they've been the engine behind markets, but with some justification. On the left, I plotted the stock price return of 10 major FANGs or global technology stocks over the last 5 years. Extraordinary. Netflix up 10, Apple up 5 or 6 times, Microsoft 10% the same. On the right, though, I plotted the evolution of their revenues, which are almost as remarkable. A near 10-fold increase in Alibaba's sales, a nearly 5-fold increase in Netflix sales. So some of that extraordinary capital appreciation is well underpinned by sales and earnings. The more so in a post-COVID world where work from home and telecommunications will be so critical. Let's turn to the fourth and final reason why I think markets have been so well supported in this year of crisis. That's the global commitment to China to climate change. We've seen from the EU recovery programme, adding to the commitments Biden has now made if he becomes US president, and China's extraordinary announcements 2 weeks ago of their 2060 climate commitments. Put together, they cover 55% of global emissions and promise one of the largest capex booms the world has ever seen. This will underpin earnings for a wide range of industries, particularly the climate-focused stocks that are so key in our portfolios. Now, this does to an extent depend on a Biden win, although a lot of these actions are being taken by US states autonomously. But the numbers there are looking encouraging. Here are the latest polls run to the figures last night. On the top left there, that 8 to 9 percentage point lead being crystallized for Biden, with leadership still in the 6 swing states. So in summary, that gives us some confidence that markets are not irrationally priced today. Indeed, if the challenges of the next few months in the political world, the contested US election, Brexit, etc., were to damage markets, we would probably modest buyers in taking our global equities modestly overweight for the remainder of 2020 and beyond. Thank you.